Welcome to Nasdaq TradeTalks, where we meet with the top thought leaders and strategists in emerging technologies, digital assets, a regulatory landscape, and capital markets. This segment is presented by Charles Schwab. I'm your host, Jill Malandrino, and joining me on the desk at the Nasdaq Market site, we have Maddie Radner, Director on the Nasdaq Market Intelligence Desk, John Tinsman, Portfolio Manager at AOTG Invest, as well as Venkat Rangapuram, CEO of Centific. We're here to discuss the economic logic of scalable infrastructure, including high ROIs, low overhead, and repeatable use cases, and how to get investment exposure to those themes. It is great to have everyone with us. Welcome to Trade Talks. And John, the macro growth story really hasn't changed, where companies are being rewarded for good growth stories.
You know what I find so compelling, even when you look back historically, is that when you look at like the Nasdaq, the QQQ, it's done better the last 15 years, 20 years, 5 years than the S&P 500 has. And I think there's a big question of asking, well, you know, why? And a lot of it comes back to more scalable businesses that achieve higher profit margins. And, you know, even the last couple of years, you know, people have been talking about, you know, is the recession coming any day now? And yet the last 3 years, I think the Nasdaq's up like 100%. And so you have a segment of companies doing incredibly well. And they're earning, you know, often, you know, year over year, you know, 50% earnings growth. I mean, NVIDIA, I think, has earned 18 times more than it did 2 years ago. So there's a segment of this economy doing very well. And I think that it makes sense for investors to think about how they can get some exposure to that segment, especially if they're worried about the rest of the economy.
Yeah. Well, Venkat, I think it's important to note from the practitioner perspective that governance-first infrastructures, now that we're talking about AI adoption, is critical, in addition to just putting, you know, the CapEx into the R&D.
Yeah. So, first of all, Jill, thanks for having me here. As AI becomes core to the enterprises and strategic to it, the readiness is no longer about experimentation, but it is way more than that, right? So, what it demands is security, scalability, and governance. So, at Centific, you know, as such as a company, we've been training majority of the models that has been out in the market today, and that has given us an unprecedented set of experiences, which has led us to believe that it's the program setup, data quality, and governance, and not the model architecture itself that determines whether AI is successful or not. And hence, we took all of our learnings and best practices and tools and technology from this experience, including about 1.8 million global domain experts that have been handfully curated by us and packaged it into a product set called as AI Data Foundry, which is what allows the enterprises to deploy AI in a safe, scalable way at very reduced capital intensive expenses.
Yeah, well, you know, it's so interesting because that's a consistent theme that's coming up on Trade Talks as well, where the competitive advantage now are companies that think cyber first, privacy first, and have really strong data governance principles in place. So it's not just traditional cost centers, but these are actual revenue drivers and part of the business model now, because it is a competitive advantage to have trust.
Correct. That's very, very true. And for enterprises, hence it becomes extremely important to create a long-term strategic connected platform to be able to churn out the AI models in a safe, secure way almost on an on-demand basis. Right? So that's where we think the market is going as we sit here today.
Yeah. And Maddie, as we look at the broader overall market, to John's point earlier, it's continuing to perform despite all of the noise and you know, the wall of worry that it's climbing.
I think the markets, we're seeing a little bit of a waiting mode ahead of large cap earnings coming up. So after the close today, we'll see Alphabet and Tesla report earnings. I think these companies are not only expected to meet expectations, but exceed expectations. We're seeing analysts really bump up their forecast growth expectations for these companies. So all eyes really are on earnings. I think AI is at the forefront of these earnings, especially when we look at the big tech earnings coming up. There's really a focus on AI spend and improved AI-driven productivity and monetization. So all eyes will be on these kind of releases that we're seeing coming up.
Yeah, it's going to be a pretty busy summer earnings season, that's for sure. John, when you think about investing in a fund, through AOT that finds these ideas. Tell us more about that. How are you screening? How are you picking out the companies that you, myself, and Venkat have been describing that are, efficient operators?
I think the biggest thing I look for is low marginal cost combined with growth. Okay, so when you think about low marginal cost, what that really means is the cost of one additional incremental unit of sale is nothing, right? So like it costs Google nothing for you to run an ad on it. It's just 100% profit margin on an additional increment. It costs Microsoft nothing when you buy an extra Microsoft Office. So these companies can grow without any debt, which is safer. They can earn much higher profit margins, but every dollar they reinvest back into the product, they also always are making it better. I mean, look at what Microsoft has done over 40 years versus a company like Boeing. One still makes an airplane, and the other one is growing just exponentially. And so AOTG launched 3 years ago. I was here with you. Since then, I think it launched in the 24s. It's trading, I think, at 51 today. So it's done incredibly well. I think better than the QQQ. And investors can use this as a tool to get exposure to, I think, what is the most compelling investment story we've seen in decades. And what that really is the automation of everything, right? So when you think about like Visa automating payments and Google automating ads, AI is significantly lowering the cost of software development, right? So now you're seeing, for the first time ever, you're seeing, layoffs at Microsoft, layoffs at Amazon, layoffs at Google. So they're doing more with less. They're innovating much faster. And some of the early leaders in this, like AppLovin and Robinhood, we've seen their employee counts go down over the last 2 years. We've seen their earnings back-to-back 100% years of earnings growth. And we've seen the stock, I think both of them over the last year are up over 300%. So I kind of wonder, are these the early adopters? And we're going to see this story play out a lot more across tech.
Yeah, well, it's interesting that you discuss R&D and investing back into the business. If you look at the Nasdaq 100 over the past 20 years, those companies in aggregate do spend the most on CapEx, and you see how that's translated into growth. It's one of our favorite charts to discuss here, certainly with our index team. But
the story there is really like when Boeing makes an airplane, 99% of the revenue has to go back into buying more engines and steel to make the next airplane. With Microsoft, 99% of the revenue can go into making a product that's even better than the last one, and it provides more value to the people. And so when you think about these companies, the products they create and use are so valuable to the users, whether it's like Toast restaurant software or Microsoft Office suites. They're so valuable that nobody wants to imagine a life without them. They just want to keep using them, and they love them. And like at the end of the day, you want to own companies that create value for people, but also are always growing the value they create. And I think that the Nasdaq companies, the tech companies, are the best there is in the whole world.
Yeah, I want to go back to the trust conversation for a moment here, because AI is helping to catalyze autonomous functions and so forth, right? So this is where I think it comes back to compliance and security first, and not just deploying products, whether it's internal or external, for the sake of saying that you're doing it. Right. I don't think we've had enough time in between to capture what that could potentially look like from a risk perspective. Yep. So what are your thoughts about being really mindful of that?
Great. So so at Centific, we personally, we believe in compliance-first innovation. And what we mean by that is compliance is not a constraint for innovation, but the compliance needs to be baked in foundationally into the platform, so it can drive safer and faster product innovations, right? So for example, we have healthcare industry clients where organizations tend to process a lot of medical data which needs to be HIPAA compliant, correct? So our platform provides features such as anti-identity de-identification, bias detection, audit trails. All of these are fundamental features that is needed to ensure HIPAA compliance. While we provide that as a feature, the real advantage to the business is they are able to develop AI models very quickly with access to clean, compliant data, which is auditable, which meets regulatory standards. That is extremely important for regulatory industries like healthcare, right? So the clients, right from day one, they are very confident that they can move to the market, go to market at the speed at which they want without worrying too much about compliance and safety and risks.
Yeah. I mean, John, even when you're thinking about looking at the fundamentals, right, that when you're building with compliance first mentality, that's going to be more cost effective in the long run anyway, because you're not going back to fix mistakes. You're not dealing, with heavy legal and fine costs as well. So it's worth it to think that way.
That's very true.
Yeah, and the whole thing, it always comes back to trust too. I mean, you can't. It's intangible. Your perception of trust in the marketplace.
Yeah, that's very, very true. And I want to go back to one of the points that John mentioned as well, which was about the cost economies of scale as it relates to Google and such. We are seeing that firsthand as well, right? So we have a product that we have launched together with an ecosystem of compute tech and model partners. This is NVIDIA and Dell. It's out there in public. It centers around vision for public safety. So you think of mass transit departments and police departments, or any place where public safety could be a cause of concern. What we are seeing is the cost of the model, it reduces significantly from the first instance to the second instance, because the use cases are repeatable and redeployable in this specific scenario. So I do agree that we are at great times, and AI is going to cut down costs substantially for the enterprises in the market. Yeah.
Well, Maddie, but what about broadening out beyond that investment theme? Are there other areas, small caps, for example, that your land over there, but are you starting to see broadening out beyond the AI theme?
I think so. I think we're getting some renewed attention, especially within the small cap space, as the valuation gap continues to widen, making small caps look really discounted and relatively cheap right now. It might take some time for confidence to be fully there within the small cap space, but I think investors can continue to be selective. They can look at small caps with stronger cash flows, low debt, and who are resilient with the kind of tariff headlines that we're seeing. I think in terms of small caps, it's translating pretty well into the IPO market. We're seeing a lot of smaller companies move forward with their IPO plans. We actually saw 3 IPOs on the Nasdaq this morning. We have 190 total IPOs so far this year, including SPACs. We are really starting to see an interesting group of companies file outside of AI. We're seeing names within, broader tech, different frontier tech names, crypto names are starting to file. We're still seeing a bubbling up of SPAC activity. So we're really seeing a strong sign of recovery, momentum within the IPO space. And we've seen nearly 90% more companies go public than this time last year. So
and more diversified. Those stories where we're like, okay, what's the derivative of the AI story? And we saw a couple of those today, which is encouraging.
Oh yeah, we're seeing healthcare tech, digital asset companies. So companies that definitely have a compatibility with the AI space. But
John, what differentiates AOTG in your methodology from other innovation funds?
I think that there's some that focus on innovation. I think some of the problems that fall short is that they are often very unprofitable, right? So like when you look at like the top holdings in AOTG, you'd see whether it's like Microsoft or Google or NVIDIA, that a lot of them are large cap, blue chip, S&P 500 companies. So there's a pretty good safety there, I think, of companies that are big, but they're still able to keep growing their earnings at 20% annualized. There's a good chance of that. But the biggest thing that separates them is that the criteria to qualify is low marginal cost. There's no other ETF like it, in the market, and it's only right here on the Nasdaq that you can find an ETF that targets something like that.
Are you looking at other emerging names as well? Because you do have concentration risk at the end of the day with all those mega caps. So there are other emerging names or themes or sectors that are part of the fund?
So the ETF has to, I think it has a stricter diversification rule actually than like the Nasdaq. So the top 5% plus names have to be under 25%. So I think it's a diversified fund. The small cap names are good. In tech, sometimes you've probably seen it, Maddie. That sometimes you see stock-based compensation really change the risk-reward dynamic for investors. But some of the names I like, just going down the list is companies that just continue to automate and provide huge value. I think Toast, like, it's everywhere you go, right? It's in every restaurant, and guess what? It's not anywhere else in the world. And if we know anything about software companies, it's that they make it in the US and they sell it at the rest of the world at 100% profit margins. So like, what's the potential there 2 to 3 years from now? I mean, it's enormous. Every restaurant you talk to, they're like, I love this thing. I can't imagine my life without it, whether it's doing their software for the business, whether it's doing their payment processing. I think that there's other really good names, but I'm going to be watching the Robinhood tokenization.
Yeah.
I think that is very exciting. And I'm going to be watching, I think Microsoft, honestly, like when I think about AI, businesses will pay the most for it, and they'll pay the most for help with automating their Excel, their PowerPoints, making that with AI. And so I think they have to have an enormous competitive advantage because they've got their foot the furthest in the door with businesses.
Yeah.
It's kind of a hunch, and I like Google, I like Amazon, I like them all. But I think Microsoft, like their Copilot, right, that they sell to businesses is like 4 or 5 times the cost of Office. So if you just get like 20% of like people buying at businesses, like imagine like what the revenue will be. I mean, it's just enormous.
I can't imagine work without Copilot. It's almost like, what did we do before it, or how did we commute 5 days a week with a hybrid schedule? It's almost ubiquitous in that way. Venkat, to wrap up here, what do investors need to understand about enabling the layer behind lower margin cost AI enterprises and so forth? It's not necessarily a black box when it comes to this. You do have to be discerning when it comes to your investments.
Correct. So I think that the era of foundational models and pre-training of models is kind of, we are past that now, right? There are enough in the market. Some are expensive, some are cheap, but there is enough maturity in the market for that today. So the real things that the investors need to watch out for, especially in regards to the AI application companies, is number one, is it solving a pointed use case, or is it solving a set of use cases that are adjacently applicable to any specific industries, right? So how broad and how deep can you go with it, with obviously less capital investments and lesser costs. Number two is safety and security, because trust and safety and security is going to be a number one factor in evaluation of AI products, right? Then if these questions are answered positively, then the question becomes, okay, what is the go-to-market channel, and what is the quickest path of expansion for these products? Do they have an ecosystem of trustworthy partners who are already embedded in the necessary industries in the ecosystem to enable rapid expansion, right? So these are the feature sets I would look for in context of the companies that are in the space.
It's so interesting to hear how the safety and trust is an investment case these days. All right, appreciate everyone's insight. Thanks for joining us on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.
Thank you.